This time it's the opposite of accounts receivables. A local fitness center requires customers to pay $1,200 annual subscription upfront in cash. We're going to do the exercise from the fitness center's perspective. So as usual, we'll start from the income statement. So we've received cash. However, can we recognize this as revenue? No. We can recognize revenue when we have done our duty. So revenue is going to be recognized every month, $100 per month. So at the point we're receiving $1,200, nothing's going to happen to their income statement. Net income is going to be zero. We're going to start from zero. However, from the company's perspective, we have received $1,200, so changes in cash is going to be $1,200. We have to make adjustments. Is it going to be a operating, investing, or financing adjustment? Again, it's an operating adjustment, and we're going to say increase in deferred revenue. And if you're wondering if deferred revenue is, a liability or an asset, we've made some positive adjustments to the cash flow statements. So an increase in cash flow. So obviously it should be a liability. $1,200 would be accumulated to the year-end balance. So $1,200 increase in cash. And as mentioned, deferred revenue is under current liabilities. It's one of the items we include when we're calculating working capital. We'll cover that in later lectures as well. But anyways, $1,200 increase in cash, $1,200 increase in liabilities, and the balance matches once again. So no changes to the income statement. Revenue will be recognized when it is actually earned. No changes to net income, but $1,200 of cash has been increased, thus an adjustment worth $1,200 is required under cash flow from operations. Cash is up by $1,200, so the asset side is up by $1,200. Deferred revenue is also up by $1,200, so liabilities and equity side is up by $1,200, and the balance matches. And after 1 month, the company in the previous question, so the local fitness center, has provided a service worth $100. So now we can recognize revenue in the income statement. So revenue is up by $100. Again, we're neglecting tax. So net income would be increased by $100. And we're starting from 100. However, because we have already received cash upon signing up for the gym, no cash is being received. We have to make a negative $100 adjustment. We're going to reverse what we did just before. So a decrease in deferred revenue accounts is going to result in a $100 negative adjustment. No changes in cash, and obviously there's going to be a $100 decrease in deferred revenue, so the balance still matches. Remember that there are no changes to the total asset side and to the total liabilities and equity side. No changes. And this is going to happen for the next 12 months. So in total, revenue is going to be recognized worth $1,200, and deferred revenue is going to go down $1,200, just what we have recorded just before upon receivement of cash. Retained earnings as a result is also going to be up by $1,200. So we're just reversing what we did just before. So to sum up, revenue and net income is up by 100. And just part of the deferred revenue will be subtracted. No changes in the asset side. Deferred revenue has been replaced to retained earnings, and now the balance of the deferred revenue stands at $1,100. And this gives us a slight touch of the concept of working capital. Compared to the accounts receivables case, the deferred revenue case is much more plausible for the company owner. So at the end, revenue is the same. However, one case you receive cash upfront, and the other case you receive cash in later times. So which would you prefer as a CEO? Which would you prefer as a company owner? Obviously, you want to receive cash upfront. That's kind of the idea of working capital. So from a cash generating perspective, having a lower working capital is much more favorable to the company's cash flow. And in further, if you take further steps, it's much more favorable in DCF analysis and the company's valuation as well. So we're going to cover those in our later lectures, but for now, let's just keep on focusing on the three statement connections.